Hi, everyone. I'm Michelle Jakubowska, Marketing Associate here at Ramapo Wealth Advisors. Thanks so much for joining us today for our February 2026 market update. I'm here with Wealth Advisors James Sahagian and Alex Tierso, along with our Registered Client Service Manager, Ian Binlinson. All three are certified financial planners, and we're excited to have them here today. We'll be discussing several issues which have been dominating the news headlines over the past few weeks and providing our team's analysis. We'll also be sharing some planning updates to consider as we start the new year. Today, we'll be providing a general market overview and discussing three timely topics. One, the potential impact of the nomination of Kevin Warsh to head up to the Federal Reserve. Two, breaking down the run in precious metals like gold and silver. Three, the impact of AI on various industries, in particular the enterprise software sector. And lastly, going over 2026 employer plan contributions. So James, please provide us with an update on where we are in the markets today.
Thank you so much, Michelle. And I just wanted to take note that as we record this February 2026 market update, it's a historic day. Literally just minutes ago, the Dow crossed 50,000 for the first time in history. I'd also note that my first day as a financial advisor was March 29th, 1999, and that was the first day that the Dow ever crossed 10,000. So here we are nearly 27 years later, and the Dow crossed this milestone number of 50,000. So I thought that was noteworthy, and I wanted to reference it as we kick off today's market update. As we look at the status of the market, as I just mentioned, we hit an all-time high on the Dow. The S&P and NASDAQ are not far behind, but they are off a little bit off their highs. I think it's really important to take note of where we have come over the past 30 years. And as you can see on the chart in front of you, since 1997, there have been several cycles, positive and negative, where the market has rallied significantly and then pulled back significantly. Obviously, the ups are more than the downs because, as I said, from 99 till now, we've gone from 10,000 to 50,000 on the Dow, and the S&P 500 probably from 500 to over 7,000 just a couple weeks ago. So the market has been in a steady uptrend, albeit with, pullbacks along the way. And the current bull market that we're in began in October of 2022. The S&P 500 bottomed out in October of 2022 at just above 3,500. As I mentioned, we just touched a little bit above 7,000 a couple weeks ago in January as the S&P hit all-time highs. And that rally that began in October of 2022 kind of coincided with the release of ChatGPT's, from OpenAI, their release of ChatGPT. This has really kind of been center stage for the conversation on artificial intelligence and all the miraculous things that are now able to be accomplished with large language models and really making it relevant for individual usage, corporate usage, government usage. There's so many different applications covering a wide variety of industries that artificial intelligence is really going to change the way we live our lives in a very material way. So the market has nearly doubled in the last 3 years, but prior to that, we had a 25% pullback in 2022 as the inflation numbers got out of control. We hit over 9% in the summer of 2022, and that caused the Fed to raise interest rates significantly. So we go through these cycles. It's very normal to go through these cycles, and I think that's very important because sometimes people get very reactionary as pullbacks are somehow not to be expected. You should expect them, and we've had them throughout the history of the markets, and we will likely continue to have them going forward. As we look at where we are in the market today, we are trading right now at about 22 times earnings. And if you look at this chart and you look at where markets peaked at previously, we are on the very high end of valuations relative to earnings for the S&P 500. Only prior times when we were at higher valuations were in recent memory were during the dot-com bubble of 1999 and 2000. And as you can see here, this goes back to 1994. We're approaching the highest level of valuations based on price to earnings multiples, based on forward earnings that we have ever been at. So I think that's noteworthy. Why? Because when you look at anticipated future returns and you look at where you have as a starting point from valuation, on the chart in front of you, you can see for the coming 1 year, the anticipated 1 year, this is going back over the last 30 years worth of data, there's a wide dispersion, right? You have years that did very well. If you follow the dot on the line on the left-hand side of the chart, there's many times where the market did very well in the following 1 year, and there's many times where it did quite poorly. But the chart on the right-hand side, I think, gives you a lot more clarity, where you could see that there's definitely a trend that when you start with a higher valuation, historically, you could anticipate lower returns than when you start with a lower valuation. So I am not at all suggesting that we're facing a bear market in the near term, but valuation does matter. What also matters is concentration. And currently, we are in the most concentrated market we've ever experienced, where the top 10 companies in the S&P 500 at year end represented more than 40% of the entire market cap of the S&P 500. Put another way, the bottom 490 companies in the S&P 500 represented less than 60% of the entire S&P 500. And as you could see, this is historically the most concentrated we've ever seen the top 10 companies be in the S&P 500. On the right-hand side of this chart, you'll also see the green line representing earnings for those top 10 companies. And to a large extent, those companies have been outperforming in terms of growing their earnings. Despite their size, usually there's something called the law of large numbers, and you expect the larger you get, the harder it gets for a company to continue to grow as maybe a smaller or mid-sized company would be. But that actually has not been the case for these mega cap companies. And these top 10 companies, just so that we can let you know who they are, as you might know, are NVIDIA, Apple, Microsoft, Alphabet, also known as Google, Meta, also known as Facebook, Tesla, Broadcom, Berkshire Hathaway, and just recently this week, Walmart entered the $1 trillion club in terms of market value, entering the top 10. So rounding out the top 10. So these top 10 companies have a disproportionate impact, more so than ever before, on the performance of the S&P 500. So I think it's important to take note of that as we look forward. And one thing they all have in common is that most of these companies are in the technology and communication sectors, and they all are implementing AI as a central part of their business practice.
Thanks so much, James. President Trump has had a contentious and even hostile relationship with current Fed President Jerome Powell. What does the nomination of Kevin Warsh to be the next Fed chairman mean for the economy and the markets?
Thanks, Michelle. Well, this has been a political process, and the nomination, even more so this time than in previous cycles, has been very politicized. Kevin Warsh is a known entity. He's been around. He's been a member of the Federal Reserve Board for quite some time. Notably, he was on the Federal Reserve Board during Ben Bernanke's chairmanship, during the global financial crisis. The Wall Street Journal recently wrote an editorial calling Kevin Warsh the leading voice in public life for reforming the Fed. He's known as a hawk. He has been very outspoken against the Federal Reserve's ever-increasing balance sheet, which recently has surpassed $9 trillion. He has spoken out vociferously against quantitative easing, and he's also not afraid to go against the consensus. He recently penned an article, also in the Wall Street Journal, speaking about how artificial intelligence and new technologies will lead to massive productivity gains, and that deflationary impact it would have on the economy would justify further rate cuts. Now, that is not such an unusual point of view, as many other market analysts have concluded likewise, but it is contrary to his previous hawkish position against an accommodating Fed, but I think it fits in conveniently with the desires of President Trump for an easier economic policy, for lower interest rates, which he has been very critical of current Chairman Jerome Powell for keeping interest rates higher than they have been.
Yeah, James, it's almost like he had to twist his personal beliefs in a pretzel to somehow match what President Trump's were desiring and his desire for the role.
Well, perhaps. I mean, we could all be skeptical, and perhaps rightly so. But I do think it does fit in conveniently. I would also note that nominee Warsh is also married into the Lauder family, the famous Estee Lauder family, who his father-in-law Ron Lauder is a big supporter of President Trump, who allegedly came up with the idea of the U.S. acquiring Greenland. So all of these things are political, but I think, Chairman Warsh, or nominee Warsh, I shouldn't get ahead of myself. I do think he will be nominated because the Republicans still do control the Senate, and they will be the ones to determine whether or not he gets nominated. I do think he'll get nominated and will take over in May. Also, just the chart in front of you here suggests that the consensus is, the expectation on the street is that the Fed will lower interest rates a couple more times here in 2026. And, we do still have positive real interest rates because, the 10-year Treasury right now is at around 4.20, and inflation is certainly running below that. So there was a period of time not too long ago where we had negative, real rates. And, the justification for lowering interest rates is that we do still have positive real interest rates. And that should give the Federal Reserve justification for lowering further.
Thanks, James. Another topic we wanted to touch on today is the run we've seen in precious metals like gold and silver. So, Alex, what do you think led to that?
Yeah, so it took nearly 5 decades and its best year since 1979 for gold to reach a new inflation-adjusted high. It topped out at $5,626 per troy ounce on January 29th, and had a tremendous run in 2025. It was the best performing major asset class at 65% in dollar terms is what gold returned. And it did not slow down. As you can see, we brought this chart into this year, 2026. And the first month of the year, or really up until the announcement of Chairman Warsh, or future Chairman Warsh, gold went up 21% in the first 21 trading sessions of the year. And even with the pullback since the nomination of Warsh, it's still up 14.65% year to date as of the recording of the show on Friday, February 6th. So gold has had a tremendous run, and there's a lot of reasons that the market is at least thinking that might have pushed gold up. It's to James's point, we're talking about lowering interest rates. Gold historically has been used as a hedge against US dollar weakness. If you see US dollar weakness on this chart here coincides with gold's run up. The dollar has been weak against most major currencies, and we saw that play out in international equities last year, outperforming our domestic markets here. Um, Persistent government deficits and rising national debt would be another reason that gold could be rising. Central bank buying. Central banks have purchased more than 4,000 tons since they really began amping up their purchases in 2022. Obviously, we've seen a lot of geopolitical risks, kind of take hold here. Global tensions, government shutdowns, that all kind of give people pause and a little bit concern in government currency, and that's why you do see kind of a push towards gold. I will say, if we transition to the next slide, please. While central banks have amped up their purchases since the onset of 2022, in 2025, it was not central banks that did the buying. They actually purchased about 20% less in 2025 than they did the year prior in 2024. It was individual investors that purchased about 2.5 times the amount of central banks. Global gold ETFs saw $90 billion worth of inflows in 2025, and this stat is even crazier. In just January of 2026, they saw 100 billion. So we saw more in inflows in gold in January than we did in all of 2025. Hence, gold still being up 14.65% year to date. So tremendous kind of investor movement and capital flows are really what's driving the price. Next slide here, please, Michelle. Thank you. So what you may have seen in the news in 2025 a lot was something called debasement. So if you're not familiar with what debasement refers to, it's referring back to Roman times when economies used metal coins as currency, usually gold or silver. And what happened is governments began to mix in base metals into these pure gold or pure silver coins. So debasement refers to the slow erosion of a currency's value. They kept the same value, but they lowered the precious metal content. So in Rome, there used to be a coin called the denarius. It was introduced in 211 BC, and it was pretty much entirely pure silver and weighed about 4.5 grams. About 200 years later, Emperor Nero reduced the purity to about 90% and the weight to 3.4 grams to fund the rebuilding of Rome. Emperors took his lead and kept cutting the purity of the coin, and ultimately, only 200 years later, after Nero did the first cut, it only contained 2% silver. So modern debasement is, obviously we don't use coins as currency. It's much more subtle. It's printing more money. It's running larger deficits as a country, meaning we spend more than we're taking in. It's lowering real yields, right? Like James just talked about, potentially having a more accommodative stance from Chairman Warsh on interest rates, right? If we bring interest rates below where inflation is, that's negative real yields. And that's another way where, we see debasement in modern days. So gold is what's considered a hard currency. It can't be printed. It has limited supply growth. They can only mine about 1% to 2% per year, and there's no central issuer, meaning there's no government behind it. So you always have to think of gold in terms of, a pair trade like dollars. So gold isn't necessarily going up in value, but your money's getting weaker. So it's more like a measuring stick.
I just wanted to interject. We don't need to look back to Roman times to see the debasement. Months after I was born, President Nixon in August of 1971 took the US dollar off the gold standard. And, it would blow many people's mind to think about what, an ounce of gold was pegged to the US dollar at in 1971. So that number was $35. So it was $35 an ounce of gold in August 15th of 1971 when President Nixon took us off. Yeah. So when you think about that, right, we've lost more than 99% of the value of the dollar relative to an ounce of gold in the last, 55 years. Pretty remarkable.
Yeah, so debasement is a more a devaluation of currency. So it's not unique to gold. So this chart is showing us what other asset classes have performed well over the past 1, 3, 4, 5 years. Gold has been the best performer, but commodities and stocks have also performed well. If we compare this run up in the price of gold to previous gold bull runs in 1976 and starting in 1976 and 2000, we see from a magnitude perspective, it's still much lower than both the 1976 and the 2000. And from a months or a duration perspective, we're still very short of at least the early 2000s run up. And it's not uncommon to see pullbacks during that run up. So both the 1970s and early 2000s experienced 5 corrections of 10% or more. So to come back to James's comments about, Chairman Warsh, historically, nominee Warsh, historically, he was considered a hawk, meaning he might keep interest rates high, which means higher interest rates are not, would mean higher real yields, which is not kind of gold's friend, right? Gold is the opposite. When real yields become lower negative, that's when gold does well. So that sparked the largest sell-off since 1980 in the price of gold when it dropped 12% just a week ago on January 30th. Next slide, please. So our point to show you is that this is only the second time that it's crossed more than 10%, more than a larger than a 10% sell-off since this 2022 run has begun. If we look at those past 2 gold bull market runs, we can potentially have 3 more and still be trending upwards on the long term.
Thanks, Alex. Another factor that greatly impacted the market recently has been the impact of artificial intelligence on various industries, particularly the software sector. So, can you tell us about what's going on there?
Yes. So, in front of us, you see the hyperscalers, Alphabet, Amazon, Meta, Microsoft, and Oracle. If 2025 was the year of AI, artificial intelligence, or at least the first half was, the second half became when the market and investors were much more discerning about what return will we get on the investment these hyperscalers are making in AI infrastructure. So we've seen kind of a bifurcation, and some of the hyperscalers are being received positively from the market after reporting earnings and talking about how they're going to be increasing in tremendous amounts the amount of CapEx or money they're spending to build out their AI infrastructure. They're going to be doing more than 600 billion. This slide actually should be updated as of this week. 600 billion in 2026 capital spending. So that is the spending budget of Japan. It exceeds the budget of Germany and Mexico. So these are huge numbers. Luckily, many of these hyperscalers are extremely profitable and have great cash flows. So they're able to fund it from incoming money as opposed to from their balance sheet or from borrowing from equity markets. This past week, or this very week that we're in right now, the first week of February, will go down as the week Anthropic tanked the market and pulled ahead of its rivals, was a Wall Street Journal headline. And Anthropic is, you could think of them as a competitor of, OpenAI, and they have a similar AI tool to ChatGPT called Claude, and they launched it on Tuesday to the masses. And we saw the entire software as a service sector or industry have some major pullbacks because the market's thinking, or at least trying to figure out if a tool like Claude would be able to replace a lot of enterprise software out there. And it was pretty indiscriminate selling this week on Tuesday. We have seen large companies down anywhere from 15 to 30%, and the market's still trying to figure out is this an overreaction, or will there be some companies that will need to rethink their business model. But software as a service in general has been a great place to be invested over the past 15, 20 years. It's even outpaced the market in most timeframes that you measure. And the market is now kind of rethinking how will artificial intelligence affect these enterprise software companies. The bears are saying that AI can replace them, and many of the bulls are saying that, well, many of these enterprise software companies are going to be able to use AI to enhance their offering. So still TBD.
The market is always dynamic, but I think more so now than ever, this new technology is very disruptive, not just in technology, right? I mean, if you think about any industry, whether it's financial services, healthcare, utilities, even, which is really the first layer in the stack, we need power to, you know, make all of this technology and large language models possible. It sits on the very ground floor level. If we look at the AI build out as a stack, energy companies powering all this new technology is really central. And that's why, companies that are in nuclear have really, that was a technology that has really come back to the forefront because the demand for power is going to be tremendously higher than it has been. We've been increasing our need for power just incrementally, and I think, these new technologies like OpenAI, ChatGPT, like Anthropic's Claude, large language models are really going to change many, many different sectors and really increase or disrupt many legacy companies. So I think it's just something we need to watch and monitor very closely. And, there's definitely going to be winners and there are definitely going to be losers. It's a very fast changing environment we're in.
Thanks so much for your commentary, James and Alex. Now I'd like to hand it off to Yan, who will be going over 2026 employer plan contributions.
Thank you, Michelle. All right, so before we wrap up today, I want to briefly step away from the market discussion and share a quick planning note. What you're seeing on the slide is a high-level snapshot of the retirement contribution limits for 2026, meant to serve as a reference as you think about your planning this year. As you can see, IRA contribution limits increased to $7,500 this year, and the employee deferral limit for employer-sponsored plans like 401k plans and 403bs are increased as well. It's now $24,500, which gives you a bit more room to save through payroll and take advantage of employer matching. One important change to call out is the catch-up contributions in employer-sponsored plans. Beginning in 2026, if you're 50 or older and your prior year wages exceed $150,000, any catch-up contributions to employer plans must be made as Roth contributions. That means these catch-up contributions can no longer go in pre-tax. As always, these contribution limits are just one piece of the planning puzzle. How they fit into your overall strategy really depends on your tax situation and long-term goals. That's why we encourage you to share a copy of your most recent tax return with your advisors or our office at Ramapo Wealth Advisors. With that information, we are able to run detailed analysis and provide tax reports that highlight potential tax-saving strategies along with other financial planning opportunities tailored to your specific situation. And one more final reminder, it's still not too late to discuss tax-saving strategies for 2025. You still have until the tax filing deadline to make IRA contributions for the prior year, which can create meaningful tax planning opportunities. Here at Ramapo Wealth Advisors, we are well equipped with certified financial planners and advanced planning tools to help clients with more sophisticated and holistic financial planning, including tax return analysis, Roth conversion strategies, and estate planning coordination, all working together to support your long-term goals. If you have any questions about any of the topics covered today, we're always happy to review them with you individually. Back to you, Michelle.
Thanks, Yan. And thank you to all who tuned in to our February market update. If you have any questions, feel free to reach out to your advisor and let us know if you'd like us to send over today's slide deck. We really appreciate you tuning in and hope you have a great rest of your day.